All right, why don't we get started? Thank you guys for joining. So, a couple things before we get into it. First, I'm Mark LaMonica. Look after our individual investor business here in Sydney, and today we're going to talk about investing myths. But a couple announcements. So, on Tuesday we have two webinars. We have one at 1:00 during our normal slot, where I'll have a couple analysts on. So you can go and check out their coverage on our webinar sign-up page. So if you have any questions about specific stocks that they cover, come to that. And then Tuesday, we're doing an Instagram live webinar, and we're going to talk about inflation. So we've heard a lot about inflation and investing in an inflationary environment. So come tune into that, 6 p.m. Sydney time. All right, today, talking about investing myths. But before we get started, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. That being said, questions are helpful for me, makes it more fun for me, and that's why we're here, right? So there's a Q&A button on your Zoom screen if you're on Instagram Live or Facebook Live or YouTube Live or wherever else we're sending this. Just send through questions and they'll get forwarded on to me. All right. And this is our Instagram address, by the way, Morningstar Investor AU. So that's where you can go if you want to watch that on Tuesday evening at 6 p.m. All right, investing myths. We'll be speaking about investing myths today. So we're going to go through 4 different myths and probably things that you have heard. So we'll see if we can change your mind a little bit about a couple of these. But let's start with active versus passive. And there's a myth, in my opinion, going around that says active investing is dead. And of course, I'll explain what these are. Active, of course, is somebody who, or something, an algorithm that's going out there and selecting individual securities and trying to beat an index, whereas passive investing is investing in an index. So one thing I do want to say, that just because something is an index doesn't mean it's passive investing. There are a lot of active indexes, especially around all these thematic ETFs that are out there. I mean, those are essentially active indexes. Yeah, something to think about. So for active, we've got Michael Scott from The Office. So that was when he was running to what was the charity again? I don't remember. Rabies. It was rabies. Yeah, Meredith got bit by a bat, and he was running to help the one person a year that dies from rabies. And then of course over here we've got Star Wars. Jabba the Hutt, very passive, didn't move very much. But let's talk a little bit about this. So in many ways, if we go back and we look at what has happened, particularly since the GFC, we can declare that Jack Bogle from Vanguard, who is the huge proponent of passive investing, has won. So since the GFC, there has been a huge shift from active to passive management, to the point where, and this has actually grown a little bit, we look back a couple of years ago, 45% of all assets are now passively managed for shares or for stock-based funds. And that was up from 25% right before the GFC. And there's been a lot of implications of this, and we'll actually talk about the implications later when we go through some of the other myths that we have. But the argument that Jack Bogle came up with was pretty simple. I mean, he basically sat there and he said that people are paying very high fees to active managers. There's a very low percentage of those active managers that are beating the index. So why would you go out there and pay the fees? Just follow the market, invest passively. And in some ways, that is absolutely true. And a lot of the sort of larger parts of the market, that is true. But there are places that active still can be a pretty effective way to invest. And we talked about this a little bit with LICs on Tuesday, if anyone tuned into that, because LICs, of course, are actively managed. So let's look at what that means. So what we've done, and what we do every 6 months at Morningstar, is we have a report called the Active Passive Barometer, which I talk about a lot. And what the Active Passive Barometer does is it goes and it looks at different asset classes or categories that we have down here on this column, and it looks at what the success rate is for active managers versus the index that they're tracking. So a couple of things about this. Number one, we obviously want to look long term. So the only thing we really look at, we start looking at this at 10 years. We also want to divide up active management between lower cost active management and higher cost active management. Now, lower cost active management is still more expensive than passive management. So that's something important. Almost knocked over my water. That's something important something to know, but there are still sort of legacy products out there that are still charging very high fees. But one of the things that's happened with all of this money flowing into passive is that active management fees have actually been lowered, which is a good thing for us as investors. So we look across all these different categories, a couple of things jump out on us. Number one, when we start looking at large cap stocks, passive managers have a horrible track record of trying to beat the market. So if we look at US, large blend, value growth, et cetera, so those are the biggest companies. This is the most scrutinized part of the market where the most individuals and companies, institutions can invest. There's a lot of attention played here. What these numbers represent are the percentage of active managers who have beaten the index over a 10-year period. So you can see really poor when we're looking here, but gets better when we start looking at other asset classes. I can speak, I promise. So as we get into smaller stocks, a little bit better in mid cap. But there are a couple areas that particularly jump out. So number one, emerging markets. So emerging markets is a place where active managers have outperformed. The reason that they've done that is if you think about emerging markets, number one, there's a very large breadth of markets. So a lot of different countries involved there. The index is very concentrated in China. And so basically any bets outside of China would make sure that your portfolio differs significantly from that index. And talk about China in a little bit. China's not done well. So that's dragged down the index. But yeah, emerging markets, we see really good track record for active managers. The other thing is a lot of people can't invest in emerging markets. So there's not as much scrutiny, not as many people paying attention. And so that can lead to the market being less efficient, where there's a wider gap between the price and value on both sides. We can see wider swings, but that means that it's an effective place for an active manager to invest. Other high ones obviously can read real estate. So both US and global is pretty good as well. We've seen good outperformance or good percentage of active managers outperforming their passive counterparts, and then pretty good in bonds as well. So particularly high yield. So high yield are junk bonds. In many ways, that is very much like equity investing, that you're kind of picking the companies is when you have very high yields because the market's very worried about their ability to pay back the bonds. So you have very high credit risk, and it's almost like picking equities. You're almost like picking the businesses that will stay in business and still be able to pay you back, but pretty good all across fixed interest as well. So when you start thinking about your portfolio and putting together your portfolio and thinking about the different asset classes you're going into, remember there is potentially the opportunity for active management to be used in some of those more obscure asset classes. If you're using active management to pick large cap shares, particularly US large cap shares, where there is a ton of investor interest, then yeah, probably not a good way to go about that, just because you're going to pay higher fees in this case for underperformance by almost everyone. All right, we got through one myth. That is good. Moving on to the next myth, we're going to keep talking about passive investing a little bit, because I do think that, as I said, there have been a lot of impacts from this surge in passive investing. And I do think they're probably underappreciated by people. So this is Switzerland, right? They're supposed to be neutral. But I think the idea that a lot of people think is that investing passively means that you're sort of completely neutral. And that, no matter what goes up and down, this notion of owning the market. But that's not necessarily true, because markets have gotten more concentrated. as more money's gone into passive. And so let me try to explain that, and then we'll go through some examples. That most passive indexes are market cap weighted indexes. So what that means is that the bigger the company is, the more of the index that company makes up. And so we've naturally had this thing occur that as more money has flowed into passive, the bigger companies and the bigger countries, if we look globally, have gotten more and more money invested in them, and they've just grown exponentially bigger in terms of their share of the index. So what has happened is there's been a lot of concentration. And the fear that many people have is that if this reverses itself and the market goes down and we see a lot of selling, passive indexes will actually get really dragged down, because every time you sell in a passive index, you're selling more of those biggest securities, which make up more of the index, which will drag the thing down. So I think sort of the same phenomenon that's happened on the way up may happen on the way down. So let's go through a couple of examples. So let's start looking at the US. So the S&P 500 are the 500 biggest shares, biggest companies in the US. So this would be in that large cap space we were looking at before on that active passive barometer report. So if we go and we look at the S&P 500, and I pulled that today, what you're really getting at the end of the day is you're getting a lot of growth shares and blend as well, not a lot of value. And the reason for this is that the companies that have done very well in the US, basically these giant tech companies or communication services companies, but you still think of them as tech, they have dragged the market up, even though if we look at overall market depth, it's not great in terms of how the average company performed, but they've dragged the market up. And it's almost every day now that we see a new company is worth $1 trillion. And so as more and more money's poured into these passive funds, the likes of Apple and Microsoft and Tesla and Facebook have just gotten bigger and bigger and bigger. And so what you're doing now, if you're investing passively in the S&P 500, if we look at this, so these are sectors, what you're getting is more and more technology. So technology, more than a quarter of the index. Communication services, Google's in there, Facebook's in there. There's a lot of companies that you think are technology. Anyway, what are you doing if you're investing in the US? You're investing in tech. So something important to remember that, if that part of the market does not do well, the US indexes will not do well. So something to think about. Let's move a little closer to home. We'll look at Vanguard Australian shares. So we're looking at the ASX now. Now, the ASX, you can tell, is very different. Instead of whatever the US was, 33% growth, only 15% of the ASX is our growth companies. The reason for that, once again, is if we look at the giant companies that make up the Aussie market. So financial services, which should be unsurprising if you think about the big companies in Australia. So I think the big four banks, for example, and then basic materials. So that's where the miners are. So very different than the US, right? 2% in basic materials, close to 17, financial services, 30, 13.5% in the US. So my only point here is think about if you pick different markets that you're investing in, think about the different exposures you're going to get, because each one of these sectors responds differently to market cycles. Each one of these sectors responds differently to interest rates. Value and growth perform differently depending upon market conditions. And if you look at the Aussie market, this is going to get more concentrated. So right now, CBA today is 8.3% of the market. CSL is 6.35. So even though there's a lot in healthcare, a lot of that's CSL. And then when BHP, as I've said before, when BHP reorganizes, is no longer trading in London, it's going to jump up to 12, 13% of the Aussie market. So just think about what you're getting, right? So if we look at those top three, and obviously CBA and CSL will go down a little bit, but more than a quarter of what you're investing in an Aussie index is three companies, all right? a miner, a bank, and a healthcare company. So just remember that that's what you're getting in Australia. And then the other look I wanted to put out there is globally. So I looked at this BlackRock product, which actually kind of converted into an ESG product. But what is it investing in? So a lot of people think, okay, I go out and I buy a global index, and you'll read on all the literature that, there are 28 different countries or whatever it is in each one of these things. But look at the country allocation. Over 70% the US. So, the performance of any one of these other countries is not going to matter in the big scheme of things. It will be sort of rounding errors in this portfolio. Even if the rest of the world performs well, the US is going to drive returns in this. So something to think about. And there's all sorts of different ways that, as an investor, there's all sorts of different ways that you can deal with this. There are a lot of wide-ranging ETF products out there that say ex-US, so that you're not actually investing in the US. If you want to tilt that a little bit, right? If you want to buy this product and then potentially another product that does not include the US, you could bring that percentage down, even though you're still investing passively. And obviously, once again, we sort of see a heavy growth tilt, and a lot of that comes out of the US. So the only point here is passive investing. There are a lot of benefits. Really low cost, obviously. The fact that you are not going out there and making individual bets on securities, but just realize inherent in these indexes are certain biases and certain tilts towards countries and investment styles and companies and sectors. Okay, so another myth that we certainly have been hearing a lot lately, and there's a good reason for this, is that the best investments are the fastest growing companies or industries. These industries are the future, that you hear all these ridiculous stats about. And so I think a lot of people, and I don't want to stereotype people, but I will, kind of particularly investors on the younger side who have really only experienced bull markets and have particularly experienced this sort of technology-driven bull market that's occurred since the GFC, with that minor blip for COVID that quickly recovered. Have this notion that all you need to do to be a good investor is go out there and find the fastest growing industry or company, and that's where you put your money. And we've seen this influence, obviously, ETF providers with all these thematic ETFs that sound great on the surface, but I personally think over the long run are probably not going to do very well. I can expand upon, I guess. But yeah, we've just seen this notion that, the only thing you have to do to invest is you read the newspaper, and the newspaper says there's going to be more electric cars in the future than in the past, and that's where you should put all your money. Well, you're not the only person reading the newspaper. There's other sides to investing as well. So think about what you want to be. Do you want to be this turtle, or do you want to be this rabbit, who I think could still win if he, hops a little bit? But let's use some examples. All right. And I think, and I really like the book, so I'm obviously biased. I think the best book to read about this is Jeremy Siegel put out a book. So he's a professor at Wharton at the University of Pennsylvania. And the book is called Stocks for the Long Run. And what he does is he goes back historically and he looks at, and he wrote this book a little while ago, so right before the GFC. So he looked back at data between 1925, and I know I've said this a lot, 1925 and 2007, and looked at the way that many of us invest, reinvesting dividends, and went back and figured out what was the best performing share in the US. And the answer was Philip Morris. So Philip Morris is a tobacco company. It's since broken up into multiple tobacco companies. There's still a Philip Morris. There's Altria, which is its U.S. Company. Philip Morris International is their global part of it. But if you go back 1925, and obviously this is a long time, but 1925 to 2007, you invested $1,000 in Philip Morris, it would be worth $380 million in 2007. And then if we extrapolate that out to today, close to $1 billion. So over an 82-year period, Philip Morris returned 17% a year. Now, I know a lot of people are probably sitting there being like, oh, 17%, everything does that. But 17% a year over 82 years is pretty amazing. Now, if we look at that same period, and this is obviously a cherry-picked example, we'll go in and look at others. If we look at that same period and we think about all of the change in the world and the new technologies that were invented between 1925 and 2007, and then we think about cigarettes. And unsurprisingly, the amount of cigarettes smoked declined significantly over that period. So there was some growth in the beginning, but then has really declined. 1961, if we look at the US, 1961 was when smoking peaked. And then basically declined. At the same time, we've had, during that period, obviously this is part of the decline, we've had medical research come out and say smoking causes cancer. We have seen advertising cut, so these firms can't advertise anymore. In Australia, you now look at a pack of cigarettes and it's like covered with horrible images. You can't smoke most places. Not exactly a friendly time to be a cigarette company, but valuations matter and cash flow matters, and investors not being excited about a company that's continued to be able to generate cash and pay dividends has in the long run been more successful. And we'll look at an example in a second, but the important thing to remember also as investors is that expectations matter. So rather than just absolute performance, it is relative performance to what we think is going to happen. And that's what I try to say to everyone who's telling me about these thematic ETFs and all these like high flying industries and everything else, is that just remember that people think that all of these indexes or these thematic ETFs or individual companies, everyone thinks they're going to perform really well. And anything that's short of that, those expectations, could lead to very negative results. So the simple example is that, what would you rather invest in? A company that's growing 5% a year that everyone thinks is going to grow 2% a year, or a company that's growing 25% a year when everyone thought they were going to grow 40% a year? Well, history suggests that is the former. That growth needs to be looked at in terms of what those expectations are for growth. So another example that we have here, if we go back to the 70s, so 1972 to 2013, looking at two different companies. So we've got IBM and we've got ExxonMobil. So ExxonMobil, of course, is the oil and gas giant. IBM, not so much anymore, but was the cutting edge technology company for a lot of this period. Obviously now has been surpassed by other companies, which we all know about, Google, et cetera. But IBM was this cutting edge technology company. Well, you can see here who's performed a lot better. ExxonMobil has performed way better than IBM. And just once again, it's because those expectations are baked into the stock already. And those expectations are baked in terms of the valuation level that some of these shares are trading at. And it's not necessarily good for investors, right? We want to buy stuff cheaply. Just think about it. If you go out there and you buy and there's a good article in First Links today about this, you go out there and buy a company that's trading for 40 times earnings. What does that really mean? Well, that means that you are pre-buying the next 40 years of earnings from that company. Now, obviously, we're always looking forward when we're investors, but still, that is a lot. So just think about what those implications are. Another example. So this is Philip Morris. I went back basically as far. So this is Altria, turned into Altria, which is the U.S. part of this cigarette company. Went back just to show that this was still happening. So I went back as far as I could to the 70s. So I couldn't go back to 1925 just because we don't support that. But if you look at this, And this is the S&P 500. So up 19,000%, S&P 500 up 3,800%. Still very good, but just goes to show that, that sometimes the fastest growing things don't necessarily play out. All right. Oh, I have the wrong headline up here. Ignore that. We're still in myth 3. We've not gone back in time. Another really good example of this is China. So I hear a lot about investing in China, particularly right now, because China has done poorly lately. But if you go back historically, China has always been a pretty terrible place to invest. So we've got two different things. We've got Chinese returns versus US returns, and then global returns. Now, remember, the US has outperformed significantly since the GFC. Doesn't mean this is going to happen again in the future, or will it still happen in the future? But if we look at the difference between the US and China, it's pretty significant. Even before China went through its recent troubles, it's pretty significant. But if we go and we look at the economy, and this is what everyone tells me about why they're investing in China, the economy is growing so quickly, and you can see that here. So we can see GDP growth in China, and we can see GDP growth in the US up against how the equity markets have performed. So you see here, the US has not grown very quickly. So the largest growth, 2015, in the past 10 odd years, 3.1%. China has obviously had slowing growth, but still, on average, it's a lot higher. But what are some of the problems here? Number one, the expectation, I remember when China used to grow more than 10% GDP every single year. The expectation back here was probably that was going to continue to happen. Now, it hasn't materialized, even though they've done well. And the other thing, of course, is there's more, especially investing in a country, there's more to investing in a country than simply return or simply growth. Where does that growth go? So growth can go to different places. It can go to shareholders. And right or wrong, a lot of sort of Western societies are set up that shareholders are the ones that reap the benefits of growth, but it can also go to workers. It can also go to the government, all different places where the quote unquote profits can flow through economic growth. It can go to state-run companies that maybe aren't very efficient. So there's all sorts of places that can go. So all that I'm saying is not that growth is not good, but just don't make a simplistic connection between growth automatically equals great share market returns. So even though the growing companies, the growing sectors, the growing countries are going to be in the papers every day, and they're going to be talked about all the time, and there are spurts where they'll do okay, just be careful. Remember to think about what is priced into those share prices when you actually buy them. All right. We're on the last one, which is good. We're doing pretty well for time. Okay. We've got Tom Cruise in Risky Business. So that's risk. And then this is Volatility, the roller coaster. I'm obviously, a creative genius here with this stuff. All right. Risk and volatility are the same thing. So let's talk about what this means. We'll define those different terms. Anytime you hear somebody talking about risk in the financial services industry, it is most likely that they are talking about volatility. They're talking about how much a individual investment or how much your portfolio bounces around. Well, that's the way the investment industry measures it. But we need to think about, as investors, what is our risk? And our risk is, in our opinion, not achieving your goals and losing money you can never make back. So certainly risk would be volatility. And this is also volatility. You invested all your money in a company, it went bankrupt. So there'd be a lot of volatility as it went down to zero. But that's losing money you can never make back again, because once a company goes bankrupt, obviously you're out. You have no more equity in it. And then the risk of not achieving your goals. So this is why, and I'm sure people have heard me say this over and over again, so why we want to be very focused on risk capacity as investors. So risk capacity is how much risk should we take on, whereas risk tolerance, which is how a lot of the industry looks at is like, how much risk do we want to take on? So yeah, something to think about. So we want to make sure as investors that we figure out what our risk capacity is. How much risk do we need to take on? Because you exchange risk for returns, you exchange volatility for returns. As investors, how much risk do we need to take on to get the returns that we need to achieve our goals? And that's why we always go through that goals-based process. The other thing to think about, and this is hard, right? But like volatility, and the reason that there is this focus on volatility is because what volatility will do is it'll induce investors to make dumb decisions. And basically that comes once again from fear and greed. So if you sit there, and even if we want to talk about something very volatile, we want to talk about Bitcoin. So if we sit there, nobody wanted to buy Bitcoin when it was $100 for a Bitcoin. Now that it's $60,000, everyone's rushing into it. Well, is that the smartest thing in the world? What are you doing? You're obviously you're obviously being influenced by greed, this fear of missing out, and throwing a bunch of money into something at the top. Same thing happens from a fear perspective, that as the markets turn over, and obviously it hasn't really happened in a while, there's a lot of panic selling as markets start going down. Now, once again, what are you doing? You're selling low, and you are being driven by fear. So that is the issue with volatility. It's what it actually makes it do. But if you're a long-term investor, do you really care if anything bounces around? You shouldn't. Yeah, I was actually reflecting this morning. I do think about other stuff other than this, but just reflecting about sort of when I started investing, which was, late 90s, but I was still in uni then. When I started working was 2001, and just thinking about that decade, negative overall returns that decade. If you look at US shares, because, there was obviously September 11th attacks and all the uncertainty that followed that. Really bad for the share market. Or even before that, we have the .com bubble burst. Then, of course, we have the GFC happening in the later part of the decade. So in theory, a very difficult time to invest, a lot of volatility that decade, but, investing, getting that decade when you were younger is actually a great thing. So you can just try to shovel as much money into the market as possible. And then you have hopefully decades of returns after that. All right. Reflections on my misspent youth. So Lisa has a question. Lisa says, is there any evidence that shows whether it's more financially advantageous to either buy an international ETF or to buy individual international stocks? Yeah, so the thing I look back on in that, Lisa, is, when we go and we look at like that active passive barometer, for example, remember, and I'll caveat this, but these are professionals that are doing this, and the professionals are having a very difficult time beating the market. Now they have a lot of structural issues around professional investing that impact them. So number one, obviously sort of career risk and the different concerns people have there of going too far away from the herd, right? It's better to fail with everyone else sometimes at work than take a chance and fail by yourself. That's why you see a lot of sort of closet indexing. You're paying active management prices for basically the index at the end of the day. And an example of that, right? Like if I'm a global investor and I put if I'm a global active investor, I put most of my money into the US and most of my money into global tech stocks, I'm going to be pretty similar to the index. It's not exactly taking a chance. So there are those impediments from active managers, but it is difficult to beat the market. So, history would suggest that most people would do better buying a international ETF, which is just passively managed product that follows the market. Just understand sort of what you're investing in. Think about from a passive perspective if you want to tilt that a little away from the US based on your own individual goals. And then we had a question earlier that I seem to have lost somehow. from Paul. So Paul was talking about factors. So we can talk a little bit about factors. So factors, when I made the statement that, there are ETFs that follow indexes that aren't necessarily passive, right? And so a lot of these thematic ETFs are not passive. So they will have an index, FANG, which I always talk about, that ETF, it follows an index. That index has 10 securities in it that are picked by a committee. That is not passive investing. So it's important to understand that. I heard this terrible ad the other day, I think from ETF Securities, where they were talking about, what was it? I think it was Hack. It was like their global cybersecurity ETF, and talking about how all these PhDs pick it. Well, and they pick what goes into the index, and the ETF tracks the index. That's not passive investing. So right or wrong, that's not passive investing. So what Paul is talking about is another sort of tilt that ETFs get, which once again, I would say is not passive investing, is a factor-based tilt. So what that means is there are not individuals in there picking securities, but there are individuals that are using algorithms to sort of mine historic data to have a factor tilt in an index. So a factor tilt could be that I am investing in quality shares. And so I'm going through and I'm picking out factors. So a factor for a quality share could be like there's a Morningstar Moat ETF. So Moat is a sustainable competitive advantage, is a quality factor. Now our analysts come up with those. It's not really an index, but it is taking that factor-based tilt. We have also in sort of those quality ETFs, we have low leverage. So they haven't borrowed a lot of money. So financial strength is a factor. Volatility of earnings is a factor. So it's basically doing is going through and looking at all the different attributes we can track out of a share and pick out certain ones that we want to create a tilt in those portfolios. Now, I personally really, and this is my sort of investment philosophy, I really like sort of those quality tilts. To me, owning great companies, even if I have to pay a little bit more, even if they're not growing as fast, owning these quality companies, to me, that's what I'm interested in. And historically, if you go back and look at data, they've done pretty well, but just be careful, right? Like, when we go back, there's no reason the future is going to look anything like the past. And this is how everyone markets themselves. They go out and they find this index, no matter how much they have to manipulate it, so that they can show good historic returns, even if the ETF did not exist. Oh, there it is. It was in the chat, Paul. That's where I didn't find it. Yeah, Robo Global Hack. Hack is beta shares. Okay, Paul should basically just come and do these things. Robo Global. Yeah, robotics, that's what it was. This is what all these PhDs are picking, robotics. I guess that's something. So we've got a question saying, how are China ETFs going compared to, I think it got cut off, purely, it just says you. Unless you're talking about me. Yeah, I mean, listen, China just has not done well recently. And obviously, what's happened, you guys have probably followed the news and all of this, like number one, growth has sort of come down as we saw from that GDP picture. I think there's worries about the stability of the financial system in China, that there is all of this sort of bad debt floating around. We've obviously seen a couple examples with the builders in China, and just the thoughts that there are a lot more political influences on companies and markets than perhaps we have in Western countries. So China has not done well recently. I think people are, compared to the US, that's the thing. China has significantly outperformed or underperformed the US. Everybody has significantly, from share market returns, has significantly underperformed the US since the GFC. So there's just a huge gap in the performance. So if we go back, we'll go back into this slide. Yeah. So right here, we're looking at Morningstar indexes. So basically what we're saying is this is the US. So this is basically since 2010. US has done way better than global, way better than China as well. In terms of returns. So these are returns on $10,000 invested. So you invested 10 grand in the US, you've got 65,000, maybe 48,000 in the world. And yeah, now at this point, low 30s for China. So the US has significantly outperformed. That is why in a market cap weighted world, that's why the US is 71% of this index. And when I went back, I actually did this a while ago. I did this same presentation. So I updated the data today and it was 65%, probably 8-9 months ago when I updated. So the US has done very well, significantly outperformed Australia as well. But that doesn't mean it's going to happen in the future. So I think the only thing that we need to look at is if you are just shoveling your money passively into a global ETF, then you should know what you're getting. You're getting the US. Same thing on the emerging market side. China makes up a very large part, even with weak performance. We think just economically and sort of company size, China makes up a huge amount of emerging markets ETFs. And part of that, remember that, China, whether we want to argue whether it's actually an emerging market or not, it doesn't matter. It's an emerging market and will not change from an investment standpoint because that's how the indexes are constructed. So of course, when you have a country like China and then a country like Israel in those emerging market indexes, it's a lot easier for Chinese companies to be much bigger. So that's why China makes up a lot more of that index. All right. We've done it. We've answered all the questions. So anyway, if you have anything else, you can shoot them to me at mark.lamonica1@morningstar.com. A couple other things. Once again, remember those 2 webinars on Tuesday. So you don't have to listen to me. I will just ask our analyst questions and any questions that you have for them. So you can tune in Tuesday and we'll do that. And then that's at 1 p.m. Then Tuesday, 6 p.m. Sydney time. We'll do this inflation investing Instagram live thing. And then the last thing, if anyone's interested in coming to our conference, email me, I'll give you a cheap ticket. So it's February 3rd in Sydney. We have online access and we have live access. We're putting together a pretty good lineup. I think we just announced yesterday, Hamish Douglas is going to be our keynote speaker. It should be interesting to hear from him. So I was exchanging emails with someone today about Magellan. So Magellan Global has underperformed the last couple of years. So come hear what Hamish says about it. It's his first speaking gig since he's been back from Europe. And Linda says, when does the program appear on YouTube? So generally it takes a couple of days. So we put up Tuesday's webinar today. Probably won't happen to Monday is my guess, just given what Will has going on. But yeah, a couple of days later, we put all of these up on YouTube. All right. Well, thank you guys for joining. Appreciate it. And hopefully